Welcome to This Explainer. Okay, so today we're diving into something super practical, the exact step-by-step path from saving to investing. Look, if the mere thought of the stock market makes your palms sweat, don't even worry about it. We're going to map out a completely stress-free, totally manageable transition. Let's get right into it. Picture this for a second. You're doing everything right. You're saving consistently every single month, maybe $100 here, $200 there. You feel incredibly disciplined, and honestly, you're doing exactly what we've all been traditionally taught to do with our hard-earned cash. You're being responsible. But then, one random Tuesday, you open up your banking app and you get hit with this jarring cognitive dissonance. You see your money just sitting there, and despite all your hard work, it's not actually growing. Meanwhile, you're constantly hearing everyone talk about stocks, index funds, compound growth, and suddenly you're looking at your own account thinking, wait, am I doing this wrong? Is there a huge piece of the puzzle I'm just completely missing here? Well, the reason it feels so frustrating really just comes down to the math. Just imagine having a $10,000 balance sitting in a typical savings account. At a 0.5% interest rate, a whole year of that money just sitting there yields you $50. Yep, $50. Your grand reward for meticulously saving 10 grand barely covers a casual dinner out. So while saving is absolutely crucial, it rarely builds actual wealth. So the crucial point is that saving and investing actually have two completely different jobs. When we look at them side by side, it becomes crystal clear. Savings protect your money, while investments grow your money. Think of savings as a shield. It ensures your cash is totally intact and right there when you need it immediately. But investments? Investments are an engine specifically designed to multiply your money over the long haul. And just look at the staggering difference those two jobs make over a 20-year timeline. It's wild. If you keep $10,000 in savings at a 1% yield, you end up with about $12,200. But if that exact same money is invested, say tracking the historical S&P 500 average of around 10%, that 10 grand transforms into roughly $67,000. It's literally the exact same starting money, but you get a completely different outcome, all thanks to the magic of compounding. That massive mathematical difference leads us to a pretty fascinating realization. We usually assume the biggest financial divide in society is between people who save and people who spend, right? But honestly, the real wealth gap isn't between savers and spenders at all. It's between people who save and people who invest. Making that jump is the absolute key to completely changing your financial trajectory. So if the math so heavily favors investing, why do so many people get stuck at the saving stage? Why not just make the jump? Well, the barrier isn't the math, it's human psychology. It really comes down to how these two actions feel. Saving feels safe, it feels stable. You can see your money, it doesn't fluctuate, and it certainly doesn't just randomly drop 5% on a Tuesday afternoon. Investing, on the other hand, feels risky. Investments move up and down, and that emotional volatility, that genuinely scares people away. And hey, if you're sitting there thinking, look, I just don't want to lose my savings, that is a totally fair and valid fear. Totally fair. In fact, it's exactly why this transition shouldn't happen all at once. So let's walk through a 5-step path to help you transition safely, gradually, and most importantly, confidently. All right, step 1, build a real emergency fund. Before you invest a single dollar, you need 3 to 6 months of living expenses saved in cash. And this money, it stays in savings. It's not for investing. It's not for some exciting new opportunity. It is strictly for unexpected problems, a job loss, a medical emergency, or car breaking down. The number one reason people panic sell their investments is simply because they need cash too soon. So this emergency fund is literally there to protect your investments from the messy, unexpected emergencies of your own life. Moving on to step 2, and this brilliantly illustrates a great psychological trick. Separate your money mentally. Basically, think of your money as living in 2 totally distinct buckets. Bucket 1 is your safety money. This money does not move. Bucket 2 is your growth money. This money is allowed to fluctuate because its entire job is to grow over time. Drawing this distinct mental line drastically reduces your anxiety when the market inevitably goes up and down. Step 3 is to start small. Listen, there is a huge myth out there that you need thousands and thousands of dollars just to start investing. You absolutely do not. You can start with just $50 or $100 on a bunch of different platforms. The goal at this stage isn't to make some massive, life-changing profit. Your goal is simply building the habit of investing. Because over a lifetime, consistent habits matter so much more than perfectly timing the market. Okay, step 4 is to focus on simple investments first. Beginners often make this mistake of jumping straight into super complicated, high-stress strategies. Day trading, crypto speculation, that kind of thing. Don't do that. The simplest investments usually outperform the complicated ones anyway. Take index funds, for example. They let you invest in hundreds of companies all at once, which gives you instant diversification and way lower risk. Even legendary investor Warren Buffett repeatedly recommends simple, low-cost index funds for most everyday investors. Keep it simple because simple works.
And finally, step 5 is to stay disciplined and just let the math do its thing. The most powerful investing strategy is actually pretty boring. It's just consistency. Imagine you invest $300 a month. If that averages an 8% return over 25 years, you'd end up with roughly $285,000. But here is the truly mind-blowing part. You only put in $90,000 of your own money. A massive $195,000 comes purely from compound growth. That is compounding working in your favor, but it only happens if you have the discipline to stick with the plan. Think about it like this. Saving money is a lot like storing seeds in a glass jar. They are perfectly protected, safe and sound, but absolutely nothing is ever going to grow in there. Investing, on the other hand, is taking those seeds and actually planting them in the soil. Sure, it looks messy at first. It's covered in dirt, and you definitely don't see results immediately. But with time, patience, and a little discipline, those seeds grow into something far bigger and stronger than what you originally started with. Now, right about now, you're probably asking, okay, this sounds great, but what if I start planting all these seeds and the market crashes? It's a great question, and honestly, it's completely normal to worry about that. Market crashes happen. They've happened dozens of times throughout history, and they will absolutely happen again. But here is the key insight that literally changes everything. Long-term investors actually benefit from market downturns. Think about it. When the markets drop, your consistent monthly investments are suddenly buying more shares at lower discounted prices. It's like a sale, and that leads to much stronger returns when the market eventually recovers. Experienced investors stay perfectly calm during volatility because they completely reframe the situation. They think in decades, not days. So what's the core philosophy of this explainer? Well, it's this. Saving money gives you stability. It gives you a rock-solid foundation and real peace of mind. But investing gives you freedom. It gives you choices, growth, and a future where your money is actually out there working for you. The earlier you can combine both of these stages, the more powerful your financial future is going to become. You now know exactly how to safely bridge the gap between stability and freedom. So as we wrap up today's explainer, I really want you to take a hard look at your own financial journey. Are you still safely tucked away in the saving stage, or have you already started planting those seeds? Take that first step, build the habit, and start thinking in decades. Thanks so much for joining me on this explainer, and happy investing.